Hello, I'm Ben. I'm a finance professor. Today we're talking about the housing market. Housing has gone crazy since COVID. Many people are moving out of big, expensive cities to smaller, cheaper ones. And some people are relatively more wealthy than they were prior to COVID, so they want to upgrade their house. We start with what the current housing market looks like. The current average US home is worth $344,000. Home prices were up 14% 2 years ago and 21% in the last year. This is very high appreciation for real estate, which has averaged 3% per year over the last 100 years. Even recently, housing appreciated only 20% in total between January 2010 and December 2015. Mortgage rates have also risen significantly. LendingTree said that 30-year fixed mortgage rates were 3.79% in January and are now 5.25%. A 39% increase in only 5 months. These higher home prices and higher interest rates have increased average mortgage payments by 53% in the last year. The current average mortgage payment is $1,475. 1 year ago, that number was $967. Homes are not only selling at higher prices, they're selling much faster. The average home currently sells in 7 days. This is much faster than a year ago when the average home took 24 days to sell. Homes are not only selling faster, they're selling for more than the asking price. Today, 48% of homes sell for more than the asking price. This means multiple bidders. A year ago, only 38% sold more than asking price. The hottest real estate markets are in the Sun Belt. Austin, Raleigh, Tampa, Las Vegas, and Nashville are the 5 hottest markets in terms of annual home value growth. All of these cities have prices more than 30% higher than they were a year ago. As far as rents go, they have increased 16% over the last year. The average rent in the US is currently $1,927. One thing that points to the housing market cooling off is the mortgage payment to income ratio. This is calculated just like it sounds by dividing the average mortgage payment by the average income. This ratio has increased from 22% to 34% in the last year. This is because mortgage costs have increased significantly while incomes have not. And this means that mortgage costs are now more than 1/3 of your income, when a year ago they were only 1/5. Also, the current level of this metric is the same as it was right before the 2008 housing bubble. So please be careful when considering buying a house. Economists expect 5% fewer homes to sell this year compared to last year. As far as prices go, in January 2022, experts expected home prices to rise by 17%. Now in May, expectations are lower. In the next 12 months, they expect home prices to increase by 12%. So the market is cooling off, but still strong. Like I said before, please keep in mind the mortgage to income ratio if you're considering buying a house. Lastly, there was an article in the Wall Street Journal about the high-end housing market and luxury homes. Luxury homes are defined as the top 5% of the market. A year ago, the cutoff for a home to be considered a luxury home was $960,000. Today, the home needs to cost 20% more than that, or $1.15 million to be a luxury home. The value of luxury homes are increasing, but sales are slowing. Specifically, luxury home sales are down 18% in the last year. Thanks for watching. Please punch the like button below if you thought this was valuable, and I'll see you guys in the next video.